Yes guys, so now that we have seen two things, what is the initial recognition or initial measurement of an asset which is acquired in a separate transaction, and also we have seen where multiple assets are acquired in a single transaction. Now let's move into the concept of exchange of asset. What happens in the case of an exchange of asset? What is the basic phenomena here? In simple sense, I give up one asset and in exchange I acquire another asset. That's it. As simple as that. So I am giving up an asset, I am acquiring another asset from you. Very common for us when we talk about our cars. The old car, we normally give it back, especially if it is the same company from which you want to acquire the new car, because there is something called as loyalty bonus. So there is a loyalty bonus of another 50,000 rupees or 70,000 rupees or up to 1 lakh. The loyalty bonus is given. Let's say I drive a Honda car, I give it back to a Honda showroom to acquire one more car. Apart from just pricing this old car, he'll give me 1 lakh extra or 50,000 extra, saying that it is a loyalty bonus since you have stuck to the same brand. So common phenomenon. So my understanding here, in the case where I try to basically exchange two assets, the asset which is acquired should always be measured at the fair value. Should be measured at fair value. Question comes up, whose fair value? Is it the fair value of the asset given up, or is it the fair value of the asset acquired? In such case, I'll have to prefer the fair value of either the asset given up or the asset acquired, whosoever fair value is more clearly evident. Whosoever fair value is more clearly evident. But in practical scenario, asset you are purchasing, fair value is always more clearly evident than the old machinery. But if in case fair value of the old machinery which you are giving up and also the fair value of the asset acquired, both are clearly evident, then I will prefer to take the fair value of the asset given up. Clear? So I'll repeat what I said. I said whenever we have an exchange of assets in acquisition of a new asset, that means I have given up one asset to acquire another new asset. In such case, I'll have to measure the asset acquired at its fair value. Now, when I said fair value, whose fair value should I consider? Should I consider the fair value of the asset acquired, or should I consider the fair value of the asset given up? In such circumstances, I will prefer to use the fair value, whichever is more clearly evident. Whosoever fair value is more clearly evident, such fair value should be considered as the value of the asset. But if in case both the assets are evident, if in case both fair values are clearly evident, in such circumstances, prefer the asset given up fair value, not the asset acquired. Now there will always be a question, what if none of the fair value is available? I don't know what is the fair value of the asset given up, neither I know the fair value of the asset acquired. In such situation, I'll come to that. Let's take one by one. I'm talking about exchange of assets. So in simple essence, what is happening? There's an asset A and B. This I am giving up. And with the help of A, I am acquiring B. In this simple transaction, I'll have to always be concerned about this asset B which I am acquiring. How do I recognize this B or measure B? Asset acquired should be measured at fair value. Whose fair value is the question? Fair value of asset given up or asset acquired whichever is more clearly evident. Whichever is more clearly evident. My practical understanding in this case, I will say that the asset acquired fair value is very clearly evident. It is more evident than the fair value of the asset given up. Clear? Because asset given up is, let's say, the old car. The old car basically is still rough as far as the machine is concerned. The engine has already been run for 75,000 kilometers. There are few dents on all the sides of the vehicle. Probably one of the mirror is broken. Now, it is very difficult to establish fair value of such a car. But a showroom car, which I am acquiring right now, it's very easy to determine fair value because you know what is the quoted price of the car. Clear? Look at the second one. What if both the fair values are clearly evident? If fair value of asset given up and acquired both are clearly evident, use in such case fair value of asset given up. Use the fair value of asset given up. Clear? So I am saying if the fair value of asset given up and also the fair value of asset acquired both are clearly evident, in such case it is preferable to use the fair value of the asset given up. Third one. If both fair values are not clearly evident, I don't know what is the fair value of the asset given up. Neither I can find out what is the fair value of the asset acquired. Both fair values are not clearly evident. In such case, recognize the asset acquired. Recognize the asset acquired at carrying value of asset given up. If both fair value of the asset acquired or the asset given up both are not available with me, in such cases I will try to recognize the asset at the carrying value of the asset given up. Clear? So three circumstances I told you. Whichever is more clearly evident is a general phenomenon. Both fair values are clearly evident. Use the fair value of the asset given up. Both fair values are not clearly evident. Then use the carrying value of the asset given up. No recognition at fair value. Clear? To generalize this principle, I'll put a statement like this. Exchange of assets shall not be measured at fair value. Shall not be measured at fair value if. When did you not measure it at fair value? Last circumstance, where I don't know fair value of both the assets. Fair value of asset given up and the asset acquired are not clearly evident. Are not clearly evident. When the fair value of the asset given up and also the fair value of the asset acquired are not clearly evident, then you can forget about this logic. You need not measure it at fair value. Second situation. You will not measure the exchange of assets at fair value if the transaction lacks commercial substance. What do you mean by this word? The transaction lacks commercial substance. Guys, when I say that the transaction lacks commercial substance, that means there is no commercial nature in the transaction. My friend came up to me. He said he wanted to use my bike. I gave him my keys and he gave me his keys. He took my bike and he went away. There's an exchange of assets. But was there a commercial transaction involved? Absolutely no. So there the transaction itself lacks commercial substance. In such cases, not recognized in books. I won't recognize the transaction in books because the transaction should only be recognized if it can be measured in terms of money. If it lacks commercial substance, it cannot be measured in terms of money. Clear? In these two circumstances, I don't measure the exchange of assets at fair value. In case the fair value of asset given up and the asset acquired both are not clearly evident, no measuring it at fair value, but it should be measured at the carrying value of the asset given up. This is where we have already seen this case. Clear? So that's it. That will bring us to the end of discussion regarding the third part, that is regarding exchange of assets. Now let's get into the fourth part. Self-constructed assets. What do you mean by this concept of self-constructed assets first of all? Why does this concept of self-constructed assets actually arise? Guys, self-constructed asset is nothing but I am using my own resources. Let's say, for example, I wanted to construct my own office building. Instead of acquiring an office building from open market or instead of approaching an already constructed building, I bought a particular piece of land. I purchased some steel, cement, machinery, sand, everything necessary. I've appointed a builder. I've appointed an architect. Made sure that the construction happens in my supervision. I am not buying the asset as it is. I am constructing my own asset. That is called as self-constructed assets. Guys, we happen to actually visit a place where basically steel was being manufactured. Now, whenever the steel had to be dispatched, the steel has to be picked up with the help of a crane and put into the delivery vehicle. For it to be picked up, there had to be created a certain dispatch molds or a dispatch machinery. So this company, which was already into manufacturing of steel, has deployed its own resources and prepared certain stands. The stand on which the steel actually sits, so that it will be easier for the crane to pick up that particular machinery and put it there. These stands, this dispatch stands which they call, is called as a self-constructed asset. They did not buy it as it is. They manufactured the steel. The steel, using the steel that they manufactured, they created this dispatch stands. They are particularly called as the concept of self-constructed assets. Remember, whenever I get this concept of self-constructed asset, I will include all costs incurred for the construction of the asset until the asset is ready for its intended use by the management. Clear? Capitalize cost incurred until the asset is ready for the purpose for which the management intends to use the asset. Management intends to use the asset. I will capitalize all costs incurred until the asset is ready for the purpose for which the management intends to use the asset. Now, there will always be concerns about what cost to be included and what cost should not be included into the cost of this self-constructed assets. So, let us start discussing about inclusions and exclusions in cost. Inclusions, exclusions. Into the cost of a self-constructed asset, what cost should be included and what cost should be excluded? Let's see. First one, inclusions in cost. Always remember, my inclusions shall include, number one, employee cost. Arising directly from the construction of asset. Directly from construction of asset. That means a particular employees were designated only for the construction of the asset. So their employee cost, that is their salaries and all other benefits and bonuses and perquisites that they get, should be added to the cost of construction. Number two, site preparation cost. Cost of preparing the site, cleaning it up, making sure that there is an excavation which is being done, land filling which is done, that is site preparation. Third one, delivery, installation, assembling, and handling cost. The cost incurred towards delivery, their installation, assembling of the components and handling of it. If there is any professional fees which are involved, architect, structural engineer, all these people are necessary for the construction of a building. So they are professionals to whom I pay professional fees. Last one, testing. I will discuss about this concept of testing, guys. Okay. Just keep it aside. But these are the 5 costs which should be included as far as your inclusions in the self-constructed asset is concerned. The employee cost arising directly from the construction of the asset, cost for site preparation, delivery cost, installation, assembly and handling cost, professional fees for professionals who are involved in the construction of the self-constructed asset, finally testing it so that it gives you the desired result. With these 5 inclusions being in the cost, let us look at the exclusions. My exclusions include admin and general overheads. I would have anyways incurred these costs irrespective of whether I have taken up the construction of the asset or not. So they are anyways incurred, so they are not specifically attributed to this self-constructed asset, excluded. Number 2. Opening a new facility. Cost incurred for opening a new facility in the existing department, you cannot call it as a self-constructed asset. It is a separate unit altogether. So for the opening of the new facility, I have done a market research. I make sure that a project report was drafted. I make sure that I have understood what is the production capabilities of this particular plant. All those are costs which should not be included in self-constructed asset. Cost of introducing a new product. Huge cost goes into introducing a new product as far as their advertising is concerned and their marketing or branding is concerned. Such costs cannot be considered as cost of self-constructed assets. Cost of conducting business in new location. Cost of conducting business in new location. Guys, new location, new permissions, new registrations necessary. All those costs cannot be included in the cost of self-constructed assets. So what is the cost which can be included in the cost of the asset? Employee cost arising directly from the construction of the asset, your site preparation cost, delivery, handling, installation, assembly, professional fees, testing. Now, I said when I talk about testing, I will discuss about the testing in detail. Let me tell you. I'll have to call about 2 really important concepts of testing. The first important logic which I have to bring about for testing is that a failed testing cost should not be included in the cost of asset. It should be charged to P&L. Should be charged to P&L. What is this concept that you are bringing up? My question is, what did you mean when you say this? I am saying that a failed testing cost is not necessary to be included in the cost of the asset. It should be straight away charged off to P&L. What do you mean by that? What do you mean by failed testing, first of all? For example, a machinery was constructed. Okay. I wanted the milk to be introduced into the machine, and it should give me a milk powder which contains almost 7 gram protein for every 100 grams of milk powder. I was trying to make a milk powder which gives me 7 grams of protein for every 100 grams of milk powder. I was suggested by all the technicians involved, sir, this way you construct the machine and you will get your desired output. I did everything possible. The entire manufacturing facility was assembled and installed. All such assembly cost, installation cost, professional fees, everything got capitalized. Now I did a trial run. I introduced certain milk. I got the output as 100 grams of powdered milk. I gave it to the quality testing department. The quality testing department said, I'm really sorry, sir. This particular product is basically having only 5 gram protein. Then I said, wait, I have hired the professionals. So I contacted the professionals. The professionals did a little bit of change in the entire testing and again introduced a certain amount. Now I got 100 grams of output. I sent it to the testing unit and they said, sir, perfect. It is 7.2 grams of protein for every 100 grams of output. You are successful in creating the product. That testing which I have done for the second time is a successful testing. That testing, whatever cost you have incurred in this process, should be capitalized to the cost of the asset. But to the extent of the failed testing cost. What do you mean by failed testing means? Failed testing means the first testing which I conducted, where I introduced certain raw material, I got certain output, but the output was not the desired output. That is failed testing. Such failed testing cannot be included in the cost of the asset. Let's say I've run 50 test runs. All 50 fail. If you keep on adding it to the cost of the asset, your cost of the asset is going up and up. So it cannot be the situation. A failed testing should always be charged to P&L. It is not eligible to be capitalized to the cost of the asset. Clear? Second. Proceeds from trial run. You did a trial run, you got certain output. That output also you sold. It gave you minimal proceeds. Those proceeds which I received from a trial run should be reduced from the cost of asset. Guys, trial run cost you included to the cost of the asset. So proceeds from the trial run should be reduced from the cost of the asset. So this is the two important points which I wanted to include or which I wanted to focus upon when I'm talking about testing. A failed testing cost should be charged to P&L. Any proceeds which I received from trial run output should be reduced from the cost of the asset. Clear? This will bring us to the end of the concept regarding a self-generated assets. Clear? Guys, sometimes a borrowing cost can also be included to cost of asset. The cost of asset if only if it satisfies Ind AS 23. I'm not discussing further in this topic. I'm leaving it as Ind AS 23. When we come back to Ind AS 23, we will definitely discuss about when a borrowing cost can be included into the cost of the asset and what are the conditions which are necessary to be satisfied for including the borrowing cost into the cost of the asset. So this is where topic, and this is where we complete our 4 acquisition principles or 4 initial costs. So the first one, which was an asset acquired in a separate transaction. The second one is acquisition of multiple assets in single transaction. Third one is exchange of asset. Fourth one is self-constructed asset. Finally, the fifth one, which is a government grant, which I told you I will only cover it when I am discussing about Ind AS 20. Clear? So this will bring us to the end of the discussion regarding initial measurement of property, plant and equipment. Clear? Now, some allied topics also which I will discuss here. Incidental topics. The first topic which I wanted to discuss over here is payment deferred beyond normal credit terms. Beyond normal credit terms. Payment deferred beyond normal credit terms. I acquired an asset. Generally, the supplier would have given me only 30-day credit. But I requested the supplier to give me a 180-day credit. Supplier accepted. These are situations where the payments are deferred beyond the normal credit term. The paragraphs of this particular topic or this particular paragraph is commonly applicable not just to Ind AS 16, but it is also applicable to Ind AS 38 intangible asset, also applicable to Ind AS 40 investment property, and also applicable to Ind AS 2 inventory. So in all these topics, I will only talk about payment deferred beyond normal credit terms, and I will not move any further because the paragraphs as it is shall apply. What is the paragraph here? Whenever the payment is deferred beyond normal credit terms, my simple understanding is, let's say for example, you are a supplier. You would have normally offered a credit of 30 days. I am asking you, sir, next year I'll come and make the payment. What will you say? No, I'm not going to sell the product to you. I would have sold the product at 100 rupees normal. Since you said next year you'll come and pay, I said next year you pay me 110. Then what happened? So that means the purchase price of the product is inflated due to the delay in the payment terms. So that's why we say whenever the payment is deferred beyond normal credit terms, the transaction price in such situation can be broken down broadly into 2 parts. One is called purchase price and the other part is basically called my interest cost. Interest or finance cost. Clear? So what am I saying? Whenever the transaction price is, whenever the transaction has a payment deferred beyond normal credit terms, it is not possible for us to account normally because the transaction price in such circumstances include an interest and finance cost as well. So to the extent of the purchase price, this can be included in the cost of asset. This is included in cost of asset But to the extent of this interest and finance charge, finance cost, I'll have to deal it as per IND AS 23, which deals with borrowing cost. Sometimes you can add it to the cost of the asset. Sometimes you can charge it to P&L. When to capitalize, when to charge to P&L, we will discuss as a part of IND AS 23. Even up above, also I said borrowing cost can be included as a cost of the asset if it satisfies IND AS 23. This we have discussed as a part of self-constructed assets. And the same thing I am also discussing about payments deferred beyond normal credit terms. This paragraph of payments being deferred beyond normal credit terms will reappear in 38 intangible asset, IND AS 40 investment property, and IND AS 2 inventory. Clear? So it is the same treatment. There is no single difference as far as the paragraph or as far as the treatment is concerned. Clear? Only to the extent of purchase price. What is purchase price? Purchase price is nothing but that is price under normal credit terms. The price the supplier charges under normal credit terms shall be considered as purchase price or the price at which the asset should be recognized. Clear? Now, apart from this, I come up with one more logic. One more, similar logical statement which I am trying to make now. Sometimes there happens to be a situation where, let's say I have a piece of land. Okay. This land in which I wanted to construct my office premises. But until the construction was being taken place, until the construction has commenced, the building right beside me have requested me to use this open space for their parking requirements. I accepted it. I told him, yes, you can use this particular place for your parking requirements. I don't have any problem regarding that. So all those office people used to come down to my place or to my ground and to my open area and park their lands. They were paying me certain amount of incidental income from this asset. Should this incidental income, which I received until I commenced the construction, be reduced from the cost of the asset, or should I be transferring it to P&L? Or I had already certain, rocks which were already existing. It was a very hilly area in which I wanted to construct my office. I blasted all the rocks or I cut all the rocks, and these rocks were basically sold. It gave me some incidental income. This incidental income, should I capitalize, or that is, should I reduce it from the cost, or should I treat it as a transfer to the credit of P&L? So this is called as incidental income. Incidental income until asset is ready for use. I will continue capitalizing until an asset is ready for its intended use. But here I got incidental income. This incidental income should be credited to P&L. Credited to P&L and should not be reduced from the cost of the asset. Clear? So sometimes you do come across this concept of incidental income, guys. So please make sure that wherever there is an incidental income that you are receiving from that particular asset until it is ready for its intended use, keep crediting it to the P&L, and it should not be reduced from the cost of the asset. Not used. Cost of asset. Clear? So we had a very detailed discussion so far into the cost of the asset. We have been discussing into what is the initial measurement, on how do I identify what is the cost at initial measurement when you have acquired this. Now my question is very simple. Logically you think of, I purchased 100 chairs in my office. 100 chairs, okay? Each chair had a purchase price of 5,000 rupees. Each chair had a purchase price of 5,000 rupees. Now my question here is very simple. Should I capitalize each chair separately, or should I say all 100 chairs put together is one single asset where I simply call it as chairs account debit 5 lakhs? Very simple question. Very simple question, right? I'm saying if I purchase 100 chairs each of 5,000, should I capitalize chair 1, chair 2, chair 3, chair 4, chair 5 and like that over 100 chairs separately? Or can I combine all these chairs and recognize as one single asset as chairs? Which one do you think is appropriate? What is appropriate is not given by the standard. The standard never told you what is the unit of measurement. The standard never discusses about unit of measurement. Then sir, should I recognize chair by chair, chair by chair, chair by chair? Or should I recognize it as all 100 chairs put in one single transaction itself? Which one do you think is more preferable for me? In such circumstances where all the chairs are, where each chair is immaterial, each chair individually in its price is immaterial, it is preferable for you to combine the price of all the 100 chairs and capitalize it into one single transaction itself. So since the standard does not talk about any unit of measurement, it is up to you on how do you decide it. Let me write it. Unit of measurement. Unit of measurement. IND AS 16 does not prescribe any particular unit of measurement. IND AS 16 does not prescribe any unit of measurement. Therefore, aggregation of small and similar items, small and similar assets is appropriate if each asset individually is immaterial. If each asset individually is immaterial. If each asset individually is immaterial, then it is appropriate for you to aggregate the small assets which are similar in nature. Clear? So this is the concept of materiality applied into unit of measurement. Now, that will bring us to the end of the concept on initial measurement of assets or initial measurement as far as your date of acquisition of an asset is concerned. So sometimes you can aggregate them. Sometimes we see that there is an exchange of asset, self-constructed asset, multiple asset acquired in single transaction, separate acquisition, payment deferred beyond normal credit terms. you see how many parts that we have discussed under Ind AS 16 so far. So that is a comprehensive discussion that we have done with respect to initial acquisition cost at which each PPE should be recognized. Now we will have to look at what about subsequent measurement. When I say subsequent measurement, then the subsequent measurement should only be on a balance sheet date. On each balance sheet date, when I measure the asset, it is an option of the enterprise to choose between a cost approach and revaluation approach. If I apply cost approach, then what is a measurement? If I apply revaluation approach, then what is a measurement? If I have to do revaluation, when should I revalue the asset? What is the periodicity? What is the treatment of the difference in revaluation amounts? So all this discussion is pending for us, right? So we will look at the subsequent measurement of your property, plant and equipment in the next session. Clear?